higher interest rates. I see interest rates in America going to 9% because the Fed is going to have to keep on raising rates 9, simply because if inflation is 8%, the playbook says you've got to raise rates higher than inflation, which means 9%. Of course, that theory will go out the window if CPI goes down, but I don't see that happening anytime soon.
Mobius Capital founding partner Mark Mobius there. Well, our next guest says a recession is a high probability still in 2023, and as such, she continues to position portfolios defensively. Shana Sissel is a founder and president of Banríon Capital Management. Shana, always great to have you with us. So with that risk of a slowdown, what are the defensive positions that you're taking at the moment? Where do you see the opportunities?
I think large cap quality names are a place I want to be. I think it's interesting. As you pointed out, I am predicting, or I think the probability of a recession in 2023 is very high. But interestingly enough, since 1929, if you look at all the presidential cycles, there actually has never been a recession that starts in year 3 of the presidential cycle. So I'm kind of going against the grain, and history is not necessarily supportive of what I'm saying. So take this with a grain of salt, but I just don't see how we can avoid a recession with the Fed being so aggressive. And so you want to position yourself into larger cap, solid defensive names, healthcare, staples, which ironically enough are the 2 areas of the market that have had the most earnings surprises on both earnings and revenue. So these are areas where I would take a look. Some of the, defense companies, I've talked about this before. Leidos is a name that I really like right now. And then I'm just going to be really careful about my entry points and the valuations of the names that I consider for portfolios, and try to be defensive in just how I position and allocate my portfolios to make sure that I'm well protected in case there's more downside to this market.
Yeah, I'm interested in your strategy when it comes to the consumer space, because you mentioned staples, right? And I want to bring up this chart. We've seen the 3rd best return this year when it comes to consumer staples in the most recent session. In fact, some would see this as something of a bullish sign of that strength, the top sector for the day as well. What does that tell you about the strength of the US consumer and households, particularly as we had some pretty optimistic signs from the bank and lending numbers out of the big banks as well?
I don't think the consumer is as strong as people think. If you look underneath some of that consumer data, you are seeing an increase in the amount of debt through credit card usage that consumers are starting to accumulate, which is concerning because the rates on that debt are much higher than they have been in the past. So I worry about the ability for consumers to kind of handle that debt. The banks are doing well because they're getting better margin, and that would be to be expected. And they've also been very careful with the credit that they have been giving out, and much more careful in the credit risk that they have. So those are just 2 things to consider. Consumers are spending more money on things that are less frivolous. You see them spending more on food, on healthcare. And so I'm not actually as bullish on the U.S. consumer as others might be, because underneath those numbers, they aren't as strong as people think. Christmas time, the holidays will be very interesting because I don't think it's going to be a particularly strong holiday season. And if that's the case, it kind of also supports that idea that the consumer, the U.S. consumer, is not as strong as people think.
Not to mention that how much would you really take away from this earnings season, given that it's really backward looking, not to mention that the bar has already been lowered so much in the past few months?
I think that you hit it right on the head. One of the biggest problems I see is that I almost think the market wants to see earnings completely drop out. I think that would be a more positive sign for the market than this resilience, because we see the stress in the economy, we see the inflation, we see the pressure on the consumer, but we're not seeing it in earnings. And as long as that's the case, as long as employment numbers remain relatively strong and earnings remain relatively strong, that just emboldens the Fed to remain in this aggressive stance, which they've already said they're perfectly comfortable pushing us into a recession by being more aggressive now than spreading it out. And that part of that is because they were late to the game. But as long as things look the way they are, it just emboldens the Fed. And I think having earnings just drop out would be much better for market sentiment than having it where we are today, which is that they're actually pretty resilient.
Shana Sissel, good to have you with us. Thank you, founder and president at Banríon Capital Management. And don't miss a big conversation coming up later on Bloomberg TV, an exclusive interview with BlackRock Vice Chairman Philip Hildebrand. Find out how the world's biggest money manager is viewing the turmoil in the